Welcome to Fundamentals of Analyzing Real Estate Investments, my practical course on how to use professional techniques to evaluate investment opportunities in real estate. This course has been propelling students from total beginners to confident practitioners in a matter of weeks. What you'll learn: confidently evaluate the return potential of any real estate investment opportunity. Know a good investment from a bad investment. Use professional-grade investment models to evaluate your deals. Evaluate rental income properties. Evaluate fix and flips. Evaluate commercial properties. And more.
Alright, in this quick lecture, we're going to talk about why we even should conduct investment analysis. So if we think of investing in three big stages, we can think of it like this. There is a first stage where we buy the property. Now, when you buy the property, this is where the profit potential of the investment is determined, right? Because if you overpay here at this part, if you don't pay the right amount and you pay too much, you're not going to be able to maximize the profits of the investment no matter what you do to it later. Right. So at the purchase, this determines the maximum profit potential that is even possible from the deal. Now, the second part is where we do some work. This is where you try to maximize the potential profits as much as possible. Right. So you might have purchased it at a good value, at a good price. But if, say, you do the wrong kind of rehab, you spend money on making repairs or developing amenities that are not needed, not demanded by the tenants in that market, then you're going to waste money and you're not going to maximize profits. The third stage is if we sell it right when you sell it. That is when you actually realize the profits. So if you're wrong about the exit price that you can sell it for, then you're not going to make the profit that you thought you were going to make. So of these three stages, the reason why we do investment analysis is so that you can maximize your decision making or optimize your decision making at each of these three stages. But investment analysis helps you answer a few other questions, right? The questions that they help you answer if you conduct the right analysis is that, well, it helps you determine if you are paying a good price for this property. That's one of the most important reasons to conduct investment analysis is how much do you pay for this property? What is a good price? And the next question it can help you answer is, well, what should you fix or build? And how much should you spend on building or fixing that thing for this property? That again was part 2. Okay, another question investment analysis can help you answer is, do you have enough funds? Do you have enough funds to invest on your own? Do you need to get a loan? Do you need to find investment partners even after you get a loan? Are the rents high enough? A proper investment analysis will tell you what kind of rents you need to achieve to get to a certain investment return, as well as tell you whether the market or the property itself can actually achieve the rents that you need. If there's a big discrepancy between those two, then there is something to be concerned about. You're either not going to get what you need, or you're making some unreasonable assumptions about the rents. Another question I'll help you answer is, hey, what do you need to sell this property for in order to get your investment returns? The ones that you are targeting. Part of the investment analysis is projecting what you think the property is going to be worth in the future, because for a lot of investors, they're not buying and flipping within months. For a lot of investors, they may hang on to the property for some time. Sometimes years, sometimes even over a decade. Knowing how to account for what you assume the price will be, what kind of appreciation the property will go through, that will help you make a better and more informed investment decision today. And ultimately, proper investment analysis allows you to compare different properties. Is this property better than that property? And if the properties are different prices, maybe they have different rents, they have different amenities, they're different sizes. The cash flow looks different. How do you compare those properties? Well, with the proper investment analysis techniques and the tools that you're going to learn in this course, you're going to be able to compare two different properties, even if they're not exactly the same. Alright, so proper investment analysis allows you to find the few winners among the many losers in investment real estate. You're not going to invest in every opportunity that comes your way. You want to be able to find the few that are worth your time and money. So how do we actually do investment analysis, though? Well, we need to look at the cash flows now, whether that be in dollars, euros or yuan or yen or dinars. It doesn't matter. It's all about the cash flow that a property will generate for you. But what do we actually look at? Well, we look at the cash flow. The key word here is flow, which is what is coming in and out in terms of cash from the property. So what are some of these flows? Well, cash flows out might be purchase, right? When you purchase the asset, you're going to have to spend some cash. Even if you have some financing, you're going to have to put a down payment on that. So that's cash flow out. And if you're going to spend any money on rehabbing or making renovations, that is cash out. There's going to be repair and maintenance. In most cases, you're going to be paying for utilities sometimes if it's not covered by the tenant. And you're technically not paying for a vacancy. But when we look at investment analysis, when you have an empty unit, that is money that you're not earning. So we think of the out items as things that either costs you cash for real or that it prevents you from getting cash that you could get. So we account for these things in the investment analysis. But what about the opposite? So some of the cash flow ins are like rent and profits from a sale. If you sell it for more than what you paid for or as your debt gets paid down over time, especially if you're holding the property for longer periods of time, then when your debt gets paid down, you're going to have more equity there and you're going to have some profits at the sale. Some properties will also have other sources of income. A multi-family apartment may also have a laundry room or vending machines. A self-storage unit may also have a storefront to sell boxes and packing supplies and moving supplies. So there are some other different sources of income that brings additional cash for an investment that we need to factor into our analysis as an investor. So investment analysis is about analyzing the cash flows in and out and also anything that affects them. So here's a quick example of what something like that might affect the cash flow in or out of a property. Well, something pertaining to the property. Let's say that there is a bug infestation or a rat infestation at the property. Well, if you have an apartment property that has that and it's not fixed, that's going to affect the cash flows in as some tenants move out and you have tenants, potential tenants avoiding this place because of the bad reputation. Then that's something that happens internal to the property that could affect it. Right? Something external could also affect it. For example, if you have a tiny shopping mall that's doing really well in a neighborhood, but all of a sudden, 2 blocks down, there's a brand new mall. Now everybody goes there and nobody comes to the shopping mall anymore. Well, as the owner of this shopping mall, you're going to start losing money because you're going to start losing tenants. Those tenants aren't going to be able to pay for rent because they no longer have customers. So there are a lot of different factors, some of them pertaining to the property itself and some that are external to the property that could affect the cash flows of an investment. So let's take a look at an example of the cash flow. Let's look at the easiest investment in the world. You buy it for $100,000 and then you sell it for $150,000 for a $50,000 profit. Well, that is pretty easy, but we know that it's not that easy in real life because in order to make a profit like that, maybe you have to do some work, right? Maybe you buy it for 100,000, but you got to spend 25,000 to do some rehab. The right kind of rehab, that makes it look much more appealing. That gives it that curb appeal, that gives the property that look, that draws the buyer, that's willing to pay that price. So maybe, to sell it for 150, it might cost an additional 25,000 a rehab, and then your profit might only be 25,000. Okay, so let's look at the easiest investment in the world again. So here, if it costs 100,000 and then you can sell it for 150 for a 50,000 profit, what do you think of this investment? It costs 500,000. You sell it for 550,000 for 50,000 profit. I mean, the profit is the same. So are they the same? If you look at these two, are they the same? They're not the same, right? Well, if that's your intuition, then you're right. And the rest of the course, you're going to understand why. Because you're risking a lot more money to make 50,000. So looking at the cash flows, we need to look at the amounts of the cash flow in and out of the investment. Right. So initially, if you have to put a lot more out, but you're getting the same amount in, well, that's not as good of an investment because you have to put more cash in. You have to put more cash at risk to make the same amount of money. Now, on the flip side, if you have to put in the same amount of money, but you could get a lot more out without taking on additional risk, then that's a better investment. But there is something else that's also important to understand about cash flow. And let me illustrate it with this point. Which would you prefer, $100 or $10,000? Well, this one's pretty obvious, right? 10,000, of course. Well, what if we add this additional detail? What if it's between $100 today and $10,000 in 100 years? Well, you're not going to have much use for the 10,000 in 100 years. You're probably going to take the $100 today. So in real estate, oftentimes, you're going to be comparing different investment opportunities that will have different amounts of cash, but they come at different times. And it's not going to be as obvious as these first two cases. It will be something that's a little bit closer to this. Maybe $100 today or $10,000 in 20 years. Now, this one, it's not super obvious, but the correct answer is the 10,000 in 20 years. Because that is the equivalent of getting the $100 today and earning 26% a year. If you give $100 to Warren Buffett over the next 20 years, he is not likely to be able to turn those $100 into 10,000 in 20 years. So the best investor is not going to be able to do that. So you best take the 10,000. But the point to illustrate is in real estate, that amount, in the years when you're comparing the different investment opportunities, it's sometimes going to be very difficult to tell unless you have the right metrics to be able to measure and compare them on an apples to apples basis, which is what we're going to explore in the rest of the course. So what do you think is the other thing besides the amount of the cash flow? That is important to know. Well, that's right. The timing of the cash flow in and out is just as important as the amount of cash flow that's coming in and out. So let's take a quick look at a different example. Here is a rental income property. Let's say we bought it all cash. It costs $100,000. Once you buy it, you're collecting $5,000 a year in net rents. That means after expenses, these are profits. You're collecting $5,000 a year. And then let's say you sell it at the end of year 5 for a slight profit at $135,000. So this is a decent rental income property, and the total amount of profit in terms of cash over the 5 years is going to be $60,000 over there. Decent return. Well, what if we wanted to do a rehab right before selling it? Because we think it's going to increase the value of the property if we think that it's going to increase the value of the property by 50,000. Well, you spend 25,000 on the rehab. It's 20 there because we're also collecting 5,000 in rent. So, we're offsetting the cash flow there. And then to get 50, then we have an additional 25,000 in profits there. Well, what if we did the rehab in year 1? What if it looked like this instead? So if you did the rehab right after purchase, maybe you're able to collect 7,500 in rent instead of 5,000 a year. So you're able to collect more rents during the period of the hold, even if you sell it at the same price. So overall, your profits might go up more. So here, it's the same investment, same property, but when you actually make the rehab might impact the income that it can earn from the rents and maybe even what can be sold for. So these two examples are to illustrate that the timing of when you spend the cash flow to make a rehab could actually impact the entire outlook of the investment. Now, what I wanted to illustrate with all of these is that every investment opportunity has what you can call a cash flow signature. That flow of the cash out and in, and different kinds of investments will have different signatures. So we're going to look at quite a few in this course, and we're going to start with something a little bit easier. A rental income property, and walk you through the process of analyzing it. But we're going to look at a few other things as well besides the rental income property. We're going to look at a fix and flip. We're going to look at apartments. We'll look at some commercial real estate opportunities as well, and we're going to see how getting in partnerships, when you structure investments, when you have investment partners, and not just at the property level of the investment, but at each investor level. By doing this kind of analysis, it allows you as an investor to understand where each investment opportunity lie in terms of risk-reward. You want to invest in properties that have a greater reward to their risk. So if we compare investments D and F here, well, the D has a lot of risk, but the potential reward is pretty low. So you would not want to invest in DH, and you would rather invest in F, where it has much lower risk but also much higher reward potential. And how do you know what an investment is? Where along this curve? Well, you do that with investment analysis, and you're going to get the tools to be able to run that kind of analysis so that you can compare your different investment opportunities in this way. So by being able to conduct proper investment analysis, you can become a selective investor. You can do something along the lines of this, where more than 75% of the investment opportunities that come across your desk, you're able to conduct what's called a back of the envelope analysis, which is what we're going to do in the Jumpstart section next. That is a quick analysis that you can do that allows you to quickly reject most of the investment opportunities because 1. They don't fit your criteria, or 2. They just don't make enough sense in terms of the risk-reward. Now, for the few that pass that initial assessment, you will do a more detailed analysis and you start to validate your assumptions. You're going to see that process in the later case studies in this course, where the financial models are very detailed in their analysis, and it's actually what is done in the field. So at that level, you're looking at less than 1 in 5 opportunities that we get that kind of treatment. Now, if you're at a very selective firm, that might even be less than 5% that gets this detailed treatment. Ultimately, you want to invest in less than 5% of the deals that you evaluate. There's less than 1 in 20. If you're ultra selective, it might even be lower than that. By doing investment analysis, you get to know very quickly and easily where each investment opportunity should get to. Most of them will be rejected early, some of them a little bit later. And then the few good ones that really fit what you're looking for, they're going to get your investment. Okay, let's take a look at the investment analysis process. So if we break it down into the process, really, it starts with understanding your analysis scope. What are you trying to do and what information do you need in order to conduct the analysis that you're looking for? The next step would be to get the data that you need. Data like market sale prices or market rents from comps so that you know what the similar properties are selling for so that you can get a pretty good idea of what you should pay. You can get an idea of what the rents are so that you can estimate or assume the accurate rents for your analysis so that you're not over or underestimating it. And their part is to build the investment model. Now, this part usually takes finance in Excel experience, but luckily for you, you don't have to do this part. You get to skip this entire part. That's often very difficult to learn because I've already built the models for you. You just need to learn how to use them. Now this part is the most important part of the analysis, and it's often the toughest part to learn. This is the part where you test and interpret your analysis and your assumptions. It's whether what you found is consistent with what you want, right? And what does all of it mean? Does it mean it's a good investment? Does it mean that you need to pay less? Does it mean that you need to get higher rents? Does it mean that you should do a different kind of rehab? That you should spend a little bit less on it? That you might want to hold it longer? It can tell you a lot of different things when you conduct a proper analysis. The last part is take what you learned through the analysis and ultimately make a decision where you compare, reject or move forward to the next step in the process. Now if we break those steps down in terms of relative importance, most of the other ones aren't going to be as important or as difficult to master the testing and interpreting the actual analysis and what it all means. That's the part that's going to take practice, and that's the part where we are going to spend most of our time in this course. Now a quick note, the data gathering part. It may feel hard at first, and in some markets around the world where the data is not readily available online. These data challenged markets. The information that you need is not difficult to understand. It just may be difficult to gather, and you may have to use different strategies in order to get that data. But ultimately, what takes time to learn is still the actual analysis part of it. In a quick message for my international students, I use properties from America for the examples on purpose. Now the reason for that is in investment analysis. There's really two parts to it. There's the data gathering and then there's the investment analysis. The actual part, that's important and difficult to understand. The data gathering is easy to understand, although sometimes it is difficult to implement and time-consuming because some markets it's not easy to find the data. Some countries the data is going to take a little bit more work and require some other strategies that we're going to cover. But for learning the proper techniques of investment analysis and to illustrate the important concepts, I don't want you to waste your time trying to find the data in your specific market, because it's going to be different for every country, for every city. But in the US and the main US American cities, the data is easy to find. So I want you to practice where the data is easy to find so that you can focus on the actual investment analysis part. That way you can understand the important parts, and then when you do, then you can go and gather the data for your country, for your city, but you'll be much more confident with the investment analysis portion. So, in the next example, I will show you an example of data gathering and running the analysis. Now, during the data gathering part, focus on what is being gathered and why it's being gathered, not how it's gathered. If you're in the United States, you can use that method. If you're somewhere else, focus on what I'm gathering and not where or how it's gathered. That you may not be able to use Scylla where you're at, but look at why we're getting the sale prices and comps. Look at why are we getting these rental comps. But make sure you really focus on the actual analysis part. Focus on how the assumptions are used to form an investment thesis. What are we thinking about the market from, based on what we found, and what is the thinking process behind the analysis? Don't worry too much about how to use this Excel model that I'm going to show you, because you're going to get plenty of practice with these models and you're going to see it again and again. Alright, let's dive in.
Hey, wanted to let you know about some blogs, mostly about real estate, small business, and a sprinkle of other topics. Here are some recent articles that may interest you. One simple metric for evaluating rental income properties. The best and worst rental markets in the US, sort of. Major real estate trends to follow. Are real estate cycles predictable? The latte factor, when not to care about it. Pay of your new mortgage in half the time? How much life do we have left? How much money do you need to start, and much more. Links in the video description.
Hey, welcome to the Jumpstart section. In this section, I'm going to throw a lot at you. You're going to learn some of the important reasons why we're going to do investment analysis. But you're also going to do an exercise where you're going to do some market research using Zillow.com. And then take those learnings to run your own investment analysis for a rental property right away. Now, this will feel fast for some of you, so don't worry if you need to watch it over again and pause where you need to. And even after that, if there are some things that you just don't get, don't worry. If you need to watch it over again and pause where you need to. And even after that, if there are some things that you just don't get, don't worry about it. I don't introduce everything just because these are the early lectures. Okay. Now some of those things that may seem foreign to you, we're going to explore all of them in greater detail in the rest of the course at a more normal pace. So just dive in and don't worry. Alright, let's go.
Alright, in the next few lectures, you're going to learn how to evaluate a rental income property by yourself. In fact, you're not going to evaluate just a sample income property. Are you going to evaluate one in a market that you're interested in, and you're going to look at the specific property that you want to look at as well? I'm going to show you how. So first thing I want you to do is download the model that is associated with this lecture. When you download it, I want you to open it up. So the file name is called Bio Jumpstart. When you open it up, you're going to see 3 worksheets here, 2 at the bottom that are highlighted in yellow, and one that is for the example that I'm going to use in this lecture. So I want you to go to the Research tab first, and what you're going to see in front of you is what's here on the screen right now. You're going to see a lot of yellow cells on the screen. Now, I want to explain first what you're looking at, and then we're going to go ahead and use it. So when we're looking at rental income properties, usually you're not just going to be looking at one property. You want to look at what other similar properties are being listed at. So one of the exercises we're going to do is, we're going to find a group of properties that you may be interested in looking at in a particular neighborhood, and we're going to get some information about them. And then next thing we're going to do is we're going to look at that same neighborhood, but we're going to look at recent sales. Similar properties that have sold in the last 90 or 180 days. And we're going to look at what they were sold at, as well as taking some information about those properties. Then third, we're going to look at the rents of income properties right now in the market, properties that are being listed for rent. So we're going to get some rental comps as well. What the exercise is for all these 3 are going to give us is going to give us a sense of what the listings are being listed at, but what the units or homes in the area, the rental properties are actually being sold that recently. So we'll get to see whether what sell, where are they going to sell at a premium or at some sort of a discount from the listed price. That way you can get a better idea when you're looking at a listing in this particular market. You assume there's going to be a premium that you're going to have to pay, or should you assume that you might be able to get a discount? And lastly, the rental comps gives you a better idea of how much you can ask for in terms of rents when you do purchase a property in that market. So alright, now, each of these allow you to put in 7 properties to get comps. You don't have to use all of them. But for this example right here, I'm going to fill it all up. So one of the first things I want you to do is I want you to open your browser. I have a browser here and I want you to go to Zillow.com. So open it up. Type in www.zillow.com. And what's going to happen is you're going to see something like this. So I want you to enter a market that you're interested in. It's the market I'm going to be looking at is near downtown Las Vegas. And that's where I'm going to be looking at. Here, specifically, there's a certain block that I'm going to be looking at and I have it already set to here. Alright, so once you kind of find a few block radius, the neighborhood that you're interested in looking at, what I want you to do is click on the symbol here that says for sale. And I want you to click everything else and only click for sale by agent. Because that way, we're only looking at listings that are listed by real estate agents and we're not going to confuse things by those that are listed by owner or that are in other situations. Those that are listed by owners sometimes, depending on what market you're in, could be really, really, really high. And most of them tend to be much higher than what are listed by agents. Owners tend to be delusional about the values that their property is worth. So we want to leave those out and we want to look at only the ones that are listed by the agent. And then I want you to set some parameter for the number of bets for this example. I only want to look at rental income properties that are 3 bedrooms or more, and I only want to look at houses. But if you're for your example, you may want to look at different ones. The idea is you want to try to keep it the same so that you can compare them on an equal basis. If you want to look at houses, just look at houses. You want to look at apartments or condos, look at condos. But right now, let's say just click on houses first so that you can follow the exercise. Now go to the market that you're in. But you can click on houses. And again, I know it may be hard to follow along and do this at the same time. So if you feel behind, just pause this video and then when you catch up, then continue to where I'm at. Okay, so here it's like only houses. And then for some of the other metrics, you can put in whatever you want. But the most important thing I want you to put is I want you to only look at some recent listings right now, so put it at 30 days. And then when you do that, if there aren't enough listings that show up on your map, then what I want you to do is just zoom out. Here, you see that minus sign to the right, you can zoom out and it would show more listings for you. Okay, but for this one, there's enough listings for me to look at. So then once you have this area and there's listings that are interesting in for you to look at, I want you to go to the right. You'll see that when you hover over a listing on the right, it will appear on the left to tell you which listing you're looking at. So right now, if I hover over this 147, that's where it's at. It shows up on the map. So what I want you to do is right-click on the image here on the listing and then open new tab for it. Just see it, create a new tab. And what that does is, it actually opens the listing page here and it gives me some information along with photos and everything else, who the agents are, the specific, the address, the number of beds, bath square footage and the asking price and some other information about the home. So I want you to open up at least 3 of these. And when you have opened up at least 3 of these, what I want you to do then is, I want you to create a smaller version of this browser so that you could still see the listing. But then what I want you to do is to pull the Excel file right next to it, so you see something like this. So now I have my Excel document here and then I have my listing here. The first listing, and I want you to. So what we're going to do, you see here the first line. Here, we're just going to put the address. Maybe the street name so that if you want to get back to it, you could easily look it up. So I put that in for all of these right here on the left. It said, you see the include 1 equal to yes, 2 equal to no. It just means if you want this particular property to be included in the results that we're looking at. So if you're going to add it right now, let's make it a 1. And then put in some other information, the square footage. So right there is 1364. I'm going to put that in a number of rooms as 3. Number of baths as 2. The lot size is 704,007 4005 in the year it was built 1961. How many days has it been listed on Zillow? This one's recently listed only 10 days. Listing price is $147,000 and you'll see that the cell underneath automatically calculates the asking price per square foot based on the square footage here. So this one's asking for $108 per square foot and it's consistent with the calculation here on the site as well. When was it last sold this? It was last sold October of 2010 at $78,000 to $50,000. So it was sold just a little less than 6 years ago at less than 2.5 times the price. So one other thing that I want you to do is this is going to be a subjective criteria for you to keep track of, because when you look at multiple listings, you don't just want to look at the numbers when it's asking for you. Want to keep track of what you actually think about its curb appeal or how what you think of the fixtures that's inside. And as an investor, how much work is it going to take for you to bring this property to the level that you would feel comfortable with before you list it in the market? Okay, so let's do this one example right here. I'm looking at this in the front. It's fairly clean. If you're familiar with the Las Vegas market, this is kind of an average looking curb for the home. It's fairly clean. There's some that are worse, but there are some that are way better. Let's see if there's any other exterior photos. Nope. These are all kind of interior photos now. So the curb here, I would just give it something in the middle. It's pretty average. Although the fixtures look like this is recently renovated in very good condition. So, they're not really high quality, but they look clean, they look usable. They don't look like they need to be replaced. So I'm going to give it a 3.5 in terms of the amount of work. If as an investor, just really not too much. Probably clean up the front a little bit, make it more appealing, maybe put some landscaping here in the front. So I'm going to give it a 2. Pretty easy work here. Alright, so when you do that, after you do one of them, I want you to do it for all the other ones. Now for the properties that are listed for sale, I have 7 here where I went through the whole process, and basically what I did was I just took the different listings here and created their own tabs and then went through and entered all the information for each of the properties. Alright, now, what I want you to do when you're done with that, when you have at least 3 properties here like this, you don't have to have all 7 where you kind of created your criteria. You found all the information there and you punched it in. Then what I want you to do is go back to your original map. Go back to your original map here. And instead of for sale, I want you to click recently sold. Okay, and all things equal, you see that? Well, maybe here I don't have as many sales comps, so I will extend the period that I'm looking at because right now is only 30 days. Let's make it the last 90 days. And now with the last 90 days, you should have plenty of comps to look at. So these are sold within the last 3 months. And while those real estate market can change quickly, most markets aren't going to change all that much in a matter of 30 to 60 days. So these are going to be pretty recent comparables. Alright, so within the same market, I'm going to zoom in into this area and find relevant recently sold units, and then we're going to do the same thing. So let's take an example. We're going to get this page, the property page, and then now instead of the part where we're putting it into the recently listed for sale, we're going to put it in the recently sold. So we're going to enter some information there. And this one will give us some information about this unit so similar. Let's put in the address 6340 Bristol Way. We're going to include it in this here, and then we're going to put in the information. There's 3 beds. There's 2 baths, 3 baths, 2 baths. The square footage is 1216. Lot size is 6098. It was built in 1961. Last sold very recently because we were just looking at this. So just this. Last month so far, 137,000. And let's take a look at the photos. This thing doesn't look too good. In the front, this is not very appetizing for a potential renter. It looks very gloomy, right? Dark and gloomy. I'm going to give it a 2 for the curb appeal. Let's look inside. The inside looks a lot better. New paint. It looks like the fixtures and everything look relatively new. I'm going to give the fixtures for here. And in terms of work, there's going to be more work in the front, but really nothing to do on the inside. So we give it a 2.5 for kind of an average amount of work in the front. Alright, so you get the idea. Now, do this for several more. Do this for at least 2 more in terms of sales comps for recently sold. Until you get something like this where you have at least 3 comps here, 3 listings, and you have at least 3 comparables here. With all this information, now, once you have that done, we're going to do it one last time. So one last time. What we're going to do is now this time, we're going to put in some rental comps. So go back to your original map. And this whole time, make sure you save your original map so that you can stick in that range and you're not looking at something somewhere else. And everything you're doing is comparing it in the same market. So now, we're going to go to here instead of recently sold, we're going to select for rent and for rent. Now this market, I see that there's not a lot of units for rent, so I'm going to zoom out a little bit, and we can zoom out a little more until I can see more comparables of rent in this area. So now that I have that, I'm going to open them up. Look at the information, and we're going to enter them in. So this one's similar. You're going to put the address in just in case you want to be able to look at it again. Now, the information is very similar, but except now, we're going to be putting in the asking rent. Now, once you have all this information in there, see? 3, 2. Does it have a lot size? Yep. Okay. So let's do that kind of photo. The front doesn't look very good either. What would you give that? I give it a 2 here. All right. Fixtures. Just so you see that a lot of these for rent units here in this market, especially in Vegas, don't they seem like something that was bought and somebody kind of renovated and did some things to the front wall? That's exactly the case that we're looking at. You're not going to be the only investor oftentimes doing these kinds of investments. And so here, we see that the investors focus a lot more on the interior and didn't really do too much to the exterior. So inside, yeah, maybe 3.5, there's not much to do on the inside, but some work on the outside. So do that for all of these 3 parts, the properties listed for sale, recent sale comps, and then recent rents. Until you have something like this where you have enough properties, at least 3 properties up here that you're looking at least 3 sales comps in at least 3 rental comps. Then I'm going to tell you what they all mean.